Yeah, silver was going up all during that time. We're way higher than we were in 2020. We were $30 then. We're now, either side of 50. But it was underperforming gold. So gold's done better over the last 5 years. But during that time, you can draw a couple lines on that top chart, the spread chart, technical lines. There's the black downtrend, which you bumped a month ago, and then last month downticked ever so slightly from that line, thereby acknowledging the line as being valid. Okay, and then there's the red horizontal line above you on that spread chart, top chart, just above 1.3%, meaning divide silver into gold. If it's 1.3%, you're bumping that line. Okay, actually 1.32%, and you break out over that base. That base goes back 3 years, so it's a wide base. Why is this spread important? What would cause that is not just a thought process, but pain, because that's what drives people to reject old prevailing ideas and go to some new idea. In this case, a resurrected idea that's already been there before for 3,000 years. Gold's been money, in a lot of places, including here, until Roosevelt and then Nixon got rid of that. So yeah, I think we're headed there, and I think one of the factors that will help spark that sense of 52 card pickup, panic, is when you break the stock market. And I think it is in a topping process and has been since late last year. The S&P made a new high by 10% so far this year, above the early year highs. But many indexes and sectors did not. But anyway, I think we're topping in the stock market. And when that breaks, that creates a movement of money out of a bursting asset into what is perceived to be, that's a better place to be. T-bonds aren't the alternative this time. In 2000 to 2002, and from 2007 to 2009, when the stock market went down, T-bonds went up in price, down in yield. So did gold. So they were both alternatives. This time around, T-bonds are sick.
A tipping point often arises when major asset markets crack and money flows out of inflated sectors toward perceived alternatives. Consider how equities may be topping now. Some indices show internal divergences even as headline highs persist. In prior cycles, bonds offered the escape. Today, yields remain suppressed and bond markets are vulnerable. That leaves monetary metals, particularly gold, as one of the few viable alternatives alive. As panic begins, the reallocation could accelerate. It's not only a move into gold, but away from the excesses of the old regime asset structures.
They're anemic. They can't get off the mat. And this leaves gold and monetary metals as the only real alternative. This chart you've got here was in our weekend report and some prior reports. It shows a spread relationship, what we call relative performance relationship, between each monthly close in gold divided into the S&P 500, express that as a percent, and you plot it on this percent chart. This goes back to 2013, when gold was coming down, of course, from 2011 to 13. Well, so was its relative performance to the stock market. So therefore, you see a decline in the spread value. But then over the last 11 years, we plot a red line across each of the relative performance rally highs in gold measured against the S&P. And good grief, we have a 4-point line, almost flat. This is what you call a massive base. We hit it in April, backed off, didn't collapse this time. Unlike the prior hits up there at the red line, you went down, down, down. This time we went down for a couple of months. No, last month we closed right back below that line. You close out over that line, meaning if you get any month where you can divide the price of the near front month futures contract, presently that's the December gold, divide it into the S&P 500 cash, express it as a percent. If you get 60%, that's a breakout. We closed last month about 58.5%, right up against that line. Now this is, everybody says, well, we haven't broken out yet against the stock market. But remember, the S&P is a heavily distorted index. In fact, 5 of the front end stocks in that index are, they're all tech. Okay, NVIDIA, Microsoft, Apple, and et cetera, et cetera. and they constitute 30% of the entire 500 stocks. There was 5 stocks have the weighting of 30% of what's an index involving 500 stocks. So it's heavily distorted. Okay, flip the page and you'll see something interesting.
Beyond absolute price moves, relative performance charts offer insights. When you compare gold's value to broad equity indices, you see a base forming, one that may signal a multi-year trend change. Gold's strength relative to one broad market index has already broken out of a decade-wide base, suggesting the change is not just beginning. The distortion of certain major indices where a handful of stocks dominate only accentuates the case. In other words, gold may not just outperform on its own, but shine even brighter as equities falter.
Here we measure gold the same way back to 2013, but against the Dow Industrials, Dow 30, the top chart. And the bottom chart is an index people seldom look at. That's the New York Composite Index, which is, huge quantity of stocks, okay, but not distorted by front-end weighted symbols. It's more evenly spread among all the symbols. And we've broken out. Because you've already broken out of the base, where you can say, okay, measured against broad stock market metrics, gold is now freshly emerged into an outperform candidate. And when you break out of some base that's 11 years wide, that's this clear, you're not just going up for a few months. The relative performance is going to smoke for a couple of years, could be. It won't just involve gold doing better than the S&P. We argue it's going to involve both gold going up and the stock market's going down, further exploding that spread. Anyway, this is a situation people need to pay attention to when they think something is over. This is just beginning. The spread relationship is sort of stunning. You look at the S&P, which has a beautiful structure. I mean, it'll explode when you get out of there, the gold relative to the S&P. But it's already broken out versus broad indices. And everybody knows right now that, yeah, the S&P and NASDAQ 100 are highly focused on just a few symbols. In fact, there's 5 or 6 symbols in the front end of NASDAQ 100. Remember, there's 100 symbols in it in the index. 5 or 6 symbols up front are 50% of the index. Why even call it an index? Just call it a call option on 5 stocks. But anyway, but everybody knows it's distorted, and they're scratching their head, and yet it doesn't seem to go down, so they've given up on that notion that you have a distorted situation, which is fine. Because when it breaks, then they'll be surprised. That's.
If gold resumes its role as money, silver often plays the leading part. Historically, when the gold-silver spread narrows in favor of silver, dramatic moves follow. Recent technicals show the silver-to-gold spread is nearing breakout levels. Not only could silver rise in sympathy with gold, but potentially outperform. What matters? Silver combines monetary characteristics with industrial applications, offering a unique dual-thrust dynamic when money flows and industrial demand align. The next few quarters may reveal whether silver becomes the rocket and gold the launch pad.
The bear market, you're talking the bear market in stocks now, okay.
Or a bull market in gold, both?
Yeah, no, it's going to be, I think gold will do more than the eightfold move, meaning $8,000. When we get there, I'll simply acknowledge in our reports we told you it probably will match at least what it did twice before under global conditions that are hardly as catastrophic pending as the ones we have now. Okay. Stock market, when it goes down, usually goes down for 2 to 3 years. You go 29 to 32, 2000, 2002, 2007 to 9. And it'll go down between, S&P down 50%, for example, 2000, 2002. But during that same time, it wasn't excuse me, AI stocks, it was .com, internet. And all the claims about internet were true. It was going to change our life. Yet the NASDAQ 100 went down 82%. 82%. I mean, it might as well gone to zero, okay? It wiped everybody out, and it took till 2016 for the NASDAQ 100 to come back up to the nominal price high it saw in 2000. So not only did it break 82%, but if you didn't get out, and we did, by the way, say out in January 2000, It took 16 years just to get back to break even, and that's nominal, not counting the degradation in the money unit. So I don't know how far the stock market will go down, but I can say it will go down seriously enough and also create the more important issue for gold and for the global sense of uncertainty about what we've done before will be when the pain comes from in the wake of the stock market decline. That's when you see, if you go back and look at the data points that everybody likes to talk about, unemployment and everything else that the Fed looks at. The real bad numbers didn't come until after the stock market really started down. You might have had some marginal indication there's decay, but the real pain to the average guy in the street did not occur until, let's say, 2008 and 9, for example.
Several macro drivers underpin the precious metals argument today. Central banks remain net buyers of gold, reducing supply available for other investors. Meanwhile, industrial demand for silver, especially in tech and solar sectors, supports its thesis. The gold-to-silver ratio remains elevated, indicating silver may be undervalued relative to gold. Add in sovereign debt burdens, currency debasement risks, geopolitical strains, and rising inflation, all feed the monetary metals narrative. Today's unique conjunction of money, debt, and technology may produce a leg up unmatched in recent decades.
Unemployment, et cetera, homes lost, et cetera. This time we have a much bigger crisis because we have a government debt crisis, not just mortgages, okay? We got Japan, US, there's others. It can't be printed away this time. And if they try to, which they will, print it away, monetary excess, what's the prime beneficiary of that? It's always been gold, monetary metals. And this time we happen to think silver is the one that will outpace gold starting very soon in a way that is likely to really shock people. I think we even have a chart of that in this report at page 10, I think it was. Yeah, there you go. If you can focus in on that a bit there, I don't know if you can or not. Yeah, the top chart, forget the bottom chart for the moment. Top chart is simply a spread chart. Again, divide the price of the front month silver into the front month gold, express it as a percent. And you can see back, this goes back to 2020, 5 years, okay. And there was a low in early 2020 when the silver price was less than 1% the price of gold. And you exploded up out of that hole. That's when we had that sharp rally in gold and silver starting in March of 2020 through late summer, later that year anyway. 6 months of explosion in price. Well, during that time, silver really gained versus gold. It was the better place to be. But since that, in fact, that spread peaked in early 2021, since then, you can see that the spread, the black line, has zigzagged down. What does it mean? It means, yeah, silver was going up all during that time. We're way higher than we were in 2020. We were $30 then. We're now, either side of 50. But it was underperforming gold. So gold's done better over the last 5 years. But during that time, you can draw a couple lines on that top chart, the spread chart, technical lines. There's the black downtrend, which you bumped a month ago, and then last month downticked ever so slightly from that line, thereby acknowledging the line as being valid, okay? And then there's the red horizontal line above you on that spread chart, top chart, just above 1.3%, meaning divide silver into gold. If it's 1.3%, you're bumping that line, okay? Actually, 1.32%, and you break out over that base. That base goes back 3 years. So it's a wide base. Why is this spread important?
For investors and observers, the message is clear. We may be at the early stages of a long cycle where monetary metals regain primacy. That doesn't mean a straight line upward. Corrections will come. But when the pain of broken markets and eroded trust intensifies, the migration toward gold and silver could accelerate. Strategic positioning now means understanding relative spreads, global debt dynamics, central bank behavior, and monetary flows, not just following headline price moves. If this phase truly begins in earnest, history suggests the upside could surprise many.
If you go back into the 1979 surge in silver, with silver already been going up for years just like gold. So they're both in bull trends, but silver was underperforming gold, much like this chart here. But in the summer of 79, 5 months before you peaked, the spread broke out, saying, okay, yep, I've been underperforming gold the last couple of years, both going up, but silver just not going up as much. Silver said, I'm going to perform gold. Silver went up 4.5 to 5-fold in 5 months. Went from like $15 to 50, okay, in 5 months. So the bull trend went vertical, okay. The same thing happened late in the bull trend in 2010 and 11. We know the monetary metals peaked in 2011 after having been going up for a decade. But I think it was September of 2010, again, you looked at the price charts, gold and silver just trekking up, fine, everything looked good. But silver broke out on a spread chart that looked fairly similar to this one. And it said in September 2010, okay, now I'm going to beat you, gold. And silver doubled in half in 6 months in net price, okay? So that's why this spread is important, because it tells us that we're at a phase where silver, which is vastly undervalued to gold, historical measurements, going back 50 years, could zoom in relative performance and in net price. It is our argument, based on a lot of technicals we won't get into right now, but partly on the triggering of this spread, which you can see we're all about ready to break that black downtrend line. And the red line above on the spread chart that's total breakout. We're at a phase now where I think silver has likely, when this spread breaks out, to go up to 100, at least more likely closer to 200 within a couple quarters. Gold will be going up during that time, but silver will just go vertical when this spread breaks out. Now, if you look at the chart below, this is what we do. We look at momentum and structure. The spread chart has 2 breakout levels, and the momentum chart also has 2, except that the momentum chart's already broken out over its downtrend. Okay, heads up, and then that peak that we made in September and downtick slightly in October on the black line on the bottom chart, we already hit that triple top structure. Downtick slightly, didn't get slammed, very downtick. You close above that red line on the momentum chart, that spread chart will follow very quickly. So we're watching momentum as a leader. It almost always leads in this situation. So we have a situation here where we think silver is about to go vertical, but that is a signal that both monetary metals are about to go vertical, with silver in the lead. So this is what we're focused on right now.